Department, and I also co-direct the Center for Energy Law and Policy here at Penn State. And we are very pleased this afternoon to have Dean Foreman, who is the Chief Economist at the American Petroleum Institute, to join us to talk about what has been going on in the wild world of oil and gas and what wild things may still be to come. So without any further ado, I will hand it over to Dean. Just a couple of notes for our participants. For our folks who are here in person, please remember to sign in on the sheet that's outside so we have a count of the number of people that showed up, or at least showed up in the room. What we will do is we will let Dean give his talk and then open it up for questions. If you are here in person, you can just raise your hand during question time. If you are listening in on Zoom and have a question, please enter it into the Q&A, and we'll have somebody monitoring it and we'll catch those, and we'll get to as many questions as we can before we break at 5 o'clock. So with that, I'll turn it over to Dean. Thank you very much for joining us.
So thanks for the introduction, and thanks so much for having me. It's a pleasure to be here. I came here 3 or 4 years ago and got to know Andy and got to know some of your faculty. It's a really excellent department in terms of your coverage. I'm pleased to be able, in addition to the conversation we had over lunch, share this, which is the outlook that I put together as the Chief Economist at API. So I've been in this role for about 5 years, and I've worked in the industry for about 20, all told now. All facets of it, and API covers all facets of it. We are a trade association that advocates for the industry. We are, for 100 years, the premier standard-setting organization for the industry. Through our stats department and what my team does, we're also a primary data source, side by side with the U.S. Energy Information Administration. So we survey up to 90% of the industry every week, and I'm putting in context some of those data, our data, with broader economic and energy data. So today we're going to do a whirlwind tour covering everything from the global and US economies, oil markets globally and US, natural gas markets, and a little bit on petrochemicals. Okay. So I'm going to spend a disproportionate amount of time relative to the things that are in this package unpacking a summary slide that has an awful lot of information on it. And there's a lot here, but let's just take it bit by bit. The first is, let's start with the economy, because for me, having modeled energy from both an analytical and academic standpoint, all energy by country, by fuel, by sector, it ultimately comes down to the fact that there's no form of economic activity doesn't require some form of energy. So as the economy goes, so do oil and gas markets in particular. And you read the headlines, you see what's happening, right? A lot of bearish news about the US, Fed's fund rate increases, expectations of a recession. Europe, pretty bearish. China, concerns, a zero COVID policy shutting down. What do you believe? What do you see? And how do you take that apart? And part of my job is to disentangle that. So we're going to go through individual pieces of it, but the punchline of it, and we build this up for over 200 countries around the world. This is not taking some consultant's view of what world economic growth will be. But following them individually, it's worth knowing that this year, even if we're on the precipice of a recession, the world will grow close to 3% on a real basis. It's going to grow by a similar amount in the consensus expectations, whether we look to that, Bloomberg Economic Consensus, International Monetary Fund, World Bank, very similar trajectory for the next 2 years, not just this year or next year, but going out to 3% per year. And if I have 3% per year growth on a global basis, that means, based on historical relationships, next year I have to have about 1.5 million barrels per day more oil each year than I did in the prior, and about 6 billion cubic feet per day globally, more natural gas than I did in the prior. Well, what's been happening? We have a global energy crisis playing out before our eyes. On the gas side, just last week, we saw $100 per million BTU. That's equivalent of $600 per barrel oil for natural gas prices in continental Europe. We saw Asian prices at the same time go to their highest levels on a daily basis ever. abjectly short of natural gas. And on the oil side, where it's relatively more fungible, we've seen the prices come down recently. Are we out of the woods? Well, when we start looking at supply and demand, the things that you need to know first is that our drilling activity as a world is still more than 28% down as of July compared to the same point pre-COVID, July 2019. 2019 is significant because by the end of 2019 and pre-COVID, early 2020, these are the high watermarks for production, both for the US and the world, the most we've ever produced. And we're still down more than, or about 1 million barrels per day in the US in terms of crude oil production compared to what we were then. But you don't get something for nothing. And the rig productivity in the US has slipped by US Energy Information Administration estimates. Our use of drilled but uncompleted wells, so this inventory of wells that we drill but we may or may not complete in a given month, is something that we watch carefully. And it's actually accumulated in several basins rather than being utilized. And when we look at why we are down in terms of drilling, down in terms of investment, again, they're tied together. It's coming down to a combination of workforce issues, supply chain issues, financial constraints, and energy policy headwinds. And we'll unpack all of those. The number and the circle of life of different indicators that I'm showing on the right-hand side, each little bar under each concept represents the 5-year range for that concept. So you're comparing the value in the second quarter of this year, which is the last for which we have complete reporting, financial reporting for companies, with the second quarter going back to 2017 on average. And notice for revenues, over $1 trillion for the industry, the top of the 5-year range, and the green arrow going up. And by the top of the 5-year range, I mean it's positioned all the way at the right-hand side of that little bar that represents the 5-year range. Green arrow going up means it was higher than the previous quarter. A red arrow going down means it was less than the previous quarter. And most of these concepts quarter on quarter went up. Highest revenues and net income in 5 years. But you know what? We'd have to go back 10 years to find $100 oil. That's the last time. So it looks great relative to a pretty mediocre 5-year range. Notice capital expenditures, 53 billion rose from the prior quarter, and we'll look at this in detail. Up quarter on quarter, but in the middle of the 5-year range, not at the top of it. Again, 28% down in terms of drilling. The drilling activity, like the capital expenditures, right in the middle of the 5-year range, picked up, but is it enough? Is it enough when you have headwinds of lower productivity, not as many drilled but uncompleted wells to utilize? And frankly, with Russia, Ukraine, a lot of shortages to compensate for on both a US and a global basis. Our production is at the top of the 5-year range thanks to natural gas, thanks to Pennsylvania. So natural gas and natural gas liquids on top of the crude oil production have basically pushed our production up. Refinery throughput, not at the top of the 5-year range, but darn close to it. So doing pretty well and having picked up quarter on quarter. And notice with, through this summer, hitting to July, we had the highest ever nominal fuel prices on the heels of crude oil having gone to over 130 a barrel at one point. We had some demand repression that showed up. So lower demand quarter on quarter, which is somewhat unusual as you're getting into the summer driving season there. But the capital expenditures are the thing that I want to hang on, because if we're going to pull out and meet economic growth that's basically taking the economy larger than it was pre-COVID, demand worldwide and the US, it's basically very similar to where it was pre-COVID, but supply that's not for oil or for gas, how do you make ends meet? And as a world, we are between the US, we're in the middle of an unprecedentedly large strategic petroleum reserve release, 1 million barrels per day for 6 months, never larger. At the end of this, we're going to have the lowest strategic petroleum reserves since 1983. This will be by the end of next month. Our national consumption of petroleum is 30% higher than it was in 1983. So, I mean, go to your policymaker and ask, why are we comfortable as a nation having almost in 40 years the lowest strategic reserves when our consumption is higher? If it was a really calm geopolitical environment and everybody was getting along, you might say that sounds okay. But the IEA's guidance, this is the International Energy Agency, so the Paris-based IEA, their guidance to member countries is you should have 90 days of cover, 90 days of inventories. what our inventory is worth. Well, we get a little bit of a pass as the United States because we are a net exporter instead of a net importer. But our strategic reserves translate to a little over 3 weeks worth, not 3 months. So if it's a hurricane outage, which could happen in the next couple of months, maybe we're fine. But if it's something geopolitical or something major, maybe not. Gas, I already mentioned, abjectly short. As we go into winter, and we're hitting some record high prices recently, it's not clear how Europe's going to solve this. And Russia's playing hardball. They're cutting off supplies of both gas and threatening to do it for petroleum to Europe right now. And you probably saw over the weekend where Janet Yellen has borne an idea for the G7 countries in lockstep to put a price cap on Russian oil. These are real policy issues playing out. I've had conversations with congressional committees, with the Department of Energy about this. They've talked to member companies directly over previous months. And the reason it's only a G7 proposal is that it's unenforceable on a global scale. Well, and the example I'll give you is that Malaysia's exports of crude oil to China this last month, this came out last week, exceed Malaysia's crude oil production capacity. And what's happening is you're seeing Russian crude oil get shipped to a number of countries, get offloaded, get rebranded, get mixed, and then it shows up in China or another emerging market. But it's still supplying global supply. So the sanctions have leakage, the existing sanctions. If you try to put a price cap on Russian oil, you strengthen the incentives even more to game the system. So this is likely, but these low reserves in whatever comes next relative to the economy, that's the tension that we want to talk about. Now, one of the things that I think has been missing before we go into specific concepts that I just showed you is the enormity of global energy needs. So we've talked about, and you probably saw the Inflation Reduction Act that got passed this last month, right? So an unprecedented amount just going into clean energy. If we take the 155 quadrillion BTU roughly of energy that per EIA's estimates, the world consumed just in this quarter, or has consumed so far, the quarter's not quite over, 85% by their estimates is oil, gas, and coal. The remainder of this, that other 15%, a good part of that is wood and biomass, hydroelectric. When you're talking wind and solar, you're talking about 6% of global energy. If we put all of our energy into 6%, I think we should be promoting wind and solar, by the way. It just shouldn't be the only thing that's getting promoted. And right now, it's taking away resources and an administration that is actively fighting us in terms of trying to get natural gas and oil production back to where it was in 2019 in terms of drilling activity. Just a few stats, 2.1 billion tons of coal in just one quarter. I found this in the Atlantic, but this is equivalent in one quarter, the world's consumption equals what Central Appalachia has cumulatively produced in 50 years. Central Appalachia, lifetime of coal, basically in one quarter. So when we're talking about the sheer enormity, especially in emerging markets that have cost-effective coal resources and aren't slowing down, look at the right-hand side, and you see a comparison of the global economy over time with fuel by energy source. Coal doesn't go down. And in the history of the world, if we went back, Vaclav Smil and others have charts that show there's no form of energy that has gone down. And the one example they gave was maybe whale oil, but if you count that as a biofuel, that hasn't gone down either. So if the economy grows, the world needs more energy of all forms. It's continuing to grow. In terms of the little talking points for oil and natural gas, the 3 weeks of SPR that I mentioned, Strategic Petroleum Reserve coverage, it's only about 4 days of global coverage. We generally don't try to hold up or support global oil consumption with the SPR. That's kind of what we've been doing. We've been 40 to 50% of what we've released from the SPR this year has basically been exported. So it is serving a global purpose. It is helping keep prices in check, but it only makes sense if you're going to support domestic production to go with it. And on the gas side, the number basically just reaffirms that Russia is fully 1/5 of the world's production. And at that it's systemic. It's too large to just magically try to move off and find another source. And whereas oil has found other markets by gaming the system from Russia, with gas, it's not so easy. You can liquefy it, you can ship it, but you have to build liquefaction terminals and a supply chain of carriers to do it. That doesn't happen, and it's very expensive. So a lot of Russian gas goes via pipeline, Nord Stream 1, eventually Nord Stream 2 to Europe. It's shut off on Nord Stream 1 right now. Nord Stream 2 has been put in stasis. Had that gone forward, that diversified. It wasn't going to be more gas in total going to Europe from Russia. It was just going to diversify their ability to have, frankly, more ability to hold on to their market share in Europe. But again, the point being, in one quarter, we have pretty massive energy needs as a world that require investment. And now when we track investment, we're going to look at global investment first as a flow, quarter to quarter. This is built up by, we call it the API 200, but some 200 publicly listed companies in the United States, but are largely global companies. So if you looked at IEA's tracking of global energy, oil and gas investment, the top of that green area would match. And the only differences versus their tracking would include private equity, national oil companies. That's the only thing missing. But this captures it. And notice there's no sugarcoating. The glass half full version is 52 billion of investment in the second quarter, up from 45 billion in the prior year. It's gone up. But look at the last three data points on the left-hand panel on the right-hand side of it. It went up in the fourth quarter. Coming into a new budget cycle, you might have expected starting the year that it would go up again, but it didn't. Despite higher prices, it went down. And then this quarter, it went up to the 52 billion, but it's below where it was even in the fourth quarter last year. And all 3 points are basically half what it was in 2015. Half, not enough. If we compare back to 2019, when you had a pace of over 70 billion per quarter, again, substantially down. So these are issues. And then we also track for the midstream and the downstream. So whether it's pipelines, LNG terminals, refinery and petrochemical expansion, storage facilities, we track the queue or backlog of things that are under construction. And we had $158 billion worth in this latest quarter. That's up from 145 billion in the first quarter. So that's good. It has gone up. But these numbers were over 300 billion at the end of 2020. So it's been cut in half. A generation ago in Pennsylvania, Ohio, and other places, if you got 158 billion of investment nationwide in a quarter, you would have been jumping for joy because you hadn't seen projects like this, capital intensive ones, multi-billion-dollar ones being financed and invested in the United States in a generation. But because of the shale revolution, we got these projects. So again, glass half full, it's up, but not nearly what it was just 2 years ago. Where's that 28% gap in terms of drilling activity coming from? Well, it's really easy to illustrate. So if there's one summary statistic you can think about for what's happening with global drilling activity, think of North Sea Brent crude oil, international crude oil prices for future delivery a year ahead. Historically, on a rolling basis, this has been a pretty good leading indicator of where drilling has gone. These are the drilling data that you can get right off Baker Hughes' website. So they have separate spreadsheets that give you for the US oil and gas and internationally oil and gas. Great pivot tables, great data to unpack if you love this kind of data set. Notice historically they match since 2020. Futures prices have come back just fine, but the drilling activity hasn't. There's been a big gap that's opened up and hasn't shown signs of really closing that gap. And part of what's happening here is that from the Middle East and North Africa, you're seeing a relatively fixed pool of capital being spread thinner across more proverbial mouths to feed. Low carbon energy sources, electrification, infrastructure. You've seen, because of uncertainty, a risk tolerance that's been drawn back. So you're not seeing investment at the same pace. And when you tell people that you want oil and gas out of the energy mix within a decade or two, it's hard to get people to make long-lived investments in this. They're more hesitant. So if you're IHS Markit, which is a consultancy just bought by S&P Global this week, they have just changed their modeling. If they're doing discounted cash flow modeling of projects in our industry, they just raised the discount rate to 20% hurdle rate. 20% per year, that means if I don't have a project, a drill well or otherwise, that pays back in about 3 years, it's not moving forward. That's an artifact of their view. That's one view. But it's more representative of if that's what it takes to mesh with reality. It's saying that the world has a very short sight on what it's going to take to produce. It's what have you done for me lately? What have you done for me today? And not being patient to wait for long-term returns. And with multi-billion-dollar capital projects, it's not just about the commodity price, it's about capital project execution in the United States. We lose track of this very easily, but when you think from a risk management perspective of what it takes to move and advance, if I'm going to ask you for $5 billion to build an LNG train or a major pipeline or drilling program, you're going to tell me, well, okay, how are you going to build it? Where's your labor going to come from? But by the way, we still have 30% steel import tariffs in place. Where's that labor going to come from? Because we're short in so many areas. And just one or two of these projects, by the way, that we've talked about, whether it's an LNG facility and building it, whether it's a refinery or petchem expansion, the supplies of high pressure welders and electricians along the Gulf Coast, relatively short supply. Just a handful of projects going can consume substantially all of certain classes of craft labor, which means you'd say, well, you can pay more and you'll attract people into it, but you need people who are experienced if they're going to be productive. You need training, you need support for that. If you don't have the domestic labor or the regional labor in place, you either have to be able to take it from another place or you start getting creative about how you stage the work. So you can use work yards in Mexico and then bring the pieces in. How's your relationship with Mexico going? So well. You can modularize, you can build it in the Middle East or in South Korea and bring the components in. That's like, if you modularize, you add a lot of steel, you build a roll cage around it, you bring the component in and weld it together on site. The opposite is stick building. So you basically weld everything together on site. But if you're going to modularize and you add all that steel and now you're getting hit with a 30% steel import tariff, ouch, that hurts. And by the way, maybe you don't care if oil's over $100 a barrel, maybe you'd still float it. But there's another issue, is that with the tariffs, it's not just a tariff system. For many of our major trader partners, it's also a tariff where they could have opted into a quota system. So if you're Brazil and there are certain kinds of oil country tubular goods, line pipe, valves, things that you make, if you didn't produce them in the 3 years before the Trump administration put this into place, your quota was zero, meaning you can't compete to supply it, even if you could build it. So the Texas Alliance of Energy Producers, small independents across Texas, stands up and says, I can't get the pieces I need for my field. These are the issues, right? But it's all meant hesitancy in terms of bringing the activity level back for the industry. Now let's delve into the economy. We'll talk about the IMS outlook and then a couple of energy related things first. I've already mentioned the punchline that it's about 3% per year growth, and it's not expected to drop substantially. Why is that? Well, that's on the heels of $20 trillion worth of global economic stimulus. $20 trillion can't be wrong in the sense that it creates a lot of activity. If it didn't, it would be a problem, right? But we greatly expanded the money supply. We juiced the economy to an historic extent and made it larger than it was pre-COVID within 1 year, which compared to the great financial crisis is unprecedented. We should have expected price inflation. But we have two problems. One, it did result in price inflation. Two, when Janet Yellen went out and said, I was wrong about price inflation, the headline a few months ago, now the institutional credibility is damaged. So part of controlling price inflation is consumers believing that price inflation will be held in check with the right monetary policies. But is it? So these are issues. In terms of emerging markets, China's key to watch. We'll have a slide before we go into some of this. With a zero COVID policy, with a real estate crisis, there are a lot of concerns that have been making global headlines about China's economy. In the US, we care most about consumption. In China, you measure your GDP and you care the most about production and exports. And again, the message here is that when we look at it, we're concerned about rising food and other costs. We're concerned about the fragility of terms of trade and the trade balances for certain emerging markets, but China has been rebounding in the last month or two. It looks like they're pulling out of a nosedive. Having come to a pause, they're doing better now. The US, with Jerome Powell's recent hawkish statements about trying to continue to raise interest rates unilaterally at almost any cost, the US is almost unilaterally pushing itself into a recession. The expectations in the global economic consensus show this for the US. So crawling to maybe 1.5% growth next year in the consensus view. The US, when we're looking at energy markets and we realize that the amount of energy of oil and gas goes with the overall global amount of activity, We have to ground it to truth and what's the global level of activity and not just take a US-centric view. From a US-centric view, it could be painful. Now, in terms of natural gas and the oil market report from EIA, they have something interesting in common. One is it's the pickup of using diesel fuel in place of natural gas globally, and what's that doing to demand. So for the last several months, especially since Russia-Ukraine with high prices over the summer, the IEA and EIA and others have all scaled back their demand forecasts. The IEA has clipped, since Russia-Ukraine happened, literally close to 1.5 million barrels per day off of their demand forecast globally for oil. But in 1 month, just this 2 weeks ago, IEA raised their view by 400,000 barrels per day because, lo and behold, the need for the energy hasn't gone away. They're seeing a lot more diesel fuel use to generate the electricity that's needed in many emerging markets. So a couple of specific economic slides. I mentioned that for China, you track industrial production to go with economic growth. Netherlands Bureau for Economic Policy Analysis here, they do a composite weighting of industrial production indices across all the major economies. And historically, that meshes with, and this is a quarter-on-quarter annualized view of global GDP growth here from Bloomberg. We can measure the same quarter relative to the year prior, or we can do quarter-on-quarter and basically multiply by 4 with some compounding, and that's what you get. Notice the historical relationship's really good here, but the dichotomy going into the second quarter, this says that the global economy basically crawled to a halt, but yet the production indicator that's so important historically didn't. So this is watching, and it has some people speculating that there'll be upward revisions in GDP. It has some people speculating that China's industrial production numbers are overstated. Only time will tell on this, but historically industrial production's been right, and it's the underlying thing. You see the actual growth numbers in the middle. I mentioned 3% per year above average. You see it for global economy, China, the rest of developing Asia, and then the EU, and then North America. Notice EU and North America are the ones unilaterally slowing. And if you look at the pie on the right now, we don't have to look much further to figure out what's happening with the global economy. It's only a handful of regions that are going to drive the vast majority of growth, over 70% of it, to 2024 in the IMF or consensus view. So if we know China and developing Asia, that's more than half of what should happen to global growth over the next 2 years. North America, European Union is another quarter. So that gets us basically where we're going in it. Now, if we take the leading indicators for the economy for the US and China, remember I mentioned consumption's what matters for the US. So personal consumption expenditures, households and businesses buying things, 70% of the US economy in terms of level. The University of Michigan's Consumer Sentiment Index tells you very consistently, historically, we could take this back for decades, what the year-on-year growth in spending is very likely to be. Notice, one, it's dropped. So the blue line on the left, this index has dropped to some recent lows, decade lows actually. But the growth that it implies is not a contraction yet. It's just a slowing of growth. This is something to watch. With the pullback in especially energy prices this last month, this has begun to bounce some. For China and its Purchasing Managers Index, so a Purchasing Managers Index is I go to businesses and I say, what's your business look like? How many orders do you have? What kind of backlog? Do your customers have inventories? Do you have inventories? Are your prices and inventories going up or down? How do you feel? And they weight all this together. If you get a composite value or more than half or index value over 50 here, it's a diffusion index. So if the value over 50 says it's expanding, value less than 50, it's contracting. Notice the blue line has balanced. The economy, or excuse me, industrial production as a strong indicator of China's economic growth crawled to a halt. But this says it could bounce and imply close to 10% growth year on year. So we'll see, but that's a good sign for China. US consumer health. This is another thing that's been in the headlines recently. So part of the rationale for passing the Inflation Reduction Act is that US households are really stretched with high price inflation. And I think for many households, it's absolutely true that high price inflation has translated, at 9.1% translates over $400 a month for the average household. It's expensive. And 40% of US households don't have an extra $400 a month. But when we look at the savings rate in the aggregate, what we had during 2020, where it was almost 25%, was abnormal and historically high. It has come down rapidly, but it has come down, it's below the median for the last decade, but it's not at recessionary levels. That's point one. Point two is that, and this is arguably a lagging indicator. By the time you see it, you know you've got a problem. But households being more than 3 months out of date in terms of paying their mortgage, auto loans, or credit cards, that's the next thing. And the New York Fed's tracking of this in a panel shows it ticked up a little bit recently, but still historically quite low. So again, if this happens, you know you got a problem and you're likely in a recession, but we don't see that yet. One thing we do see, and it's had a consistent relationship over time, is the US dollar's relationship with the trade balance for the US. So these unilateral rate increases, the Fed funds rate has gone up by 2.25% cumulatively since the end of March. Powell has signaled that they'll continue to raise. He expected others to follow. Europe has not yet followed, but may. China has seen its currency, which is, it's not pegged anymore, but it's a de facto peg in the way they manage it versus a basket of major currencies. The dollar has a lot of weight in that basket. So China was seeing its currency, for example, relative to the Thai baht or other emerging economy currencies, appreciate. They didn't like that. It hurts their exports. So when your currency gets more expensive, things that you import become less expensive relatively. Things that you export become less competitive. And with a lag, because your exports are less competitive, you don't invest in natural gas in Pennsylvania or petrochemicals in Pennsylvania. You want the PTT, the Thai company, to come build a new ethane cracker, a second ethane cracker in Beaver County. It'd be a challenge. I didn't put it in the summary, but the last slide in this pack is going to show you what's happened to ethylene spot margins. They've gone negative for the first time in a very long time. So strong dollar is a death knell for US competitiveness from a manufacturing standpoint. In the first quarter of this year, we had a record $1.5 trillion trade deficit, goods and services, never higher. Came down a little bit in the second quarter, but still very close to record. And since then, the dollar has gone to record highs. That's the consequence of Russia-Ukraine, the dollar as a safe haven around the world. Plus, in the very short run, in the longer run, relative inflation rates determine exchange rates. But in the short run, it's all about hot flows of money. So you're seeing almost every currency around the world. You can borrow in local currency in Japan or Europe, hedge your foreign exchange risk, translate it to US dollars, and with these interest rates, earn a 2% real return. That's the game that's being played. And that's why you're seeing so much currency, so much money come into the US and US dollars. And if others don't follow suit, that so-called carry trade gets worse and worse. It's really bad for US manufacturing. This is not a good economic indicator going forward. Crude oil production, I mentioned that we're still about 1 million barrels per day down compared to where we were at the high water mark at the end of 2019, early 2020. Historically, as we've grown our domestic production, our net imports of total petroleum, crude and products, have steadily come down. In 2020, for the first time since 1958, we were a petroleum net exporter on an annual basis. In 2021, with the loss of production and more of a global pull for it, we had some backsliding, but we're still a net exporter. This year, we've hit record net exports. So July, 1.4 million barrels per day, I think, for June, and then July is close to that. The last 3 weeks in the weekly data, we've been over 2 million barrels per day of total petroleum net exports. That's never happened before, by the way. In July, the total amount of crude and products that went out was 9.6 million barrels per day. We were a net importer of 12 million barrels per day back in 2006 and 2007. So a huge reversal, but just by having this simple loss of 1 million barrels per day, it's really about the quantum and has been about the quantum of the trade gap that we've been seeing. So that segues into oil markets. I told you oil goes with the economy. Here's one way to see it. The size of the global economy is on the horizontal axis, the amount of global oil demands on the vertical axis. From years 2000 to 2019, for almost 20 years, almost linear, right? The great financial crisis on this basis, a huge economic impact, right? But just a blip from an oil market perspective in terms of demand. Very different price environment, but a blip from a demand perspective. Then you see the downturn with the COVID recession. And then from EIA's estimates, the actual recovery last year and projected for this year and the following. So first, vertically, we're expected to get to record oil demand next year. Despite diminished expectations for the global economy, despite a possible recession, we still get to global oil demand that's record next year. That's point one. The second point on this slide is now left to right in terms of the size of the global economy. Notice I mentioned earlier that within 1 year, the economy was larger than it was before COVID. 2021 versus 2021. Think back to how the Obama administration was criticized after the great financial crisis for the economy not coming back faster. For years, they were told, no, we should see it faster, stronger, but it was a steady recovery. And what's happened here is that within 1 year, you juiced it so much that you boosted the economy, but it's created price inflation that should have been anticipated. And if the Fed had understood the industries that it was monitoring, the supply chain bottlenecks, semiconductors were one particular thing that was raised as a bottleneck, saying that would alleviate within a year. But when Janet Yellen said that in that role at the Fed, not as Treasury Secretary, the issue was that the semiconductors that go into automotives that were driving the prices up were of an older generation. And it was like trying to go to Home Depot right now and on the shelf, look for an incandescent light bulb. Can you find one? They don't exist, right? And the plants to make them have been shut down. And that's what happened to the older generation of chips going into cars during COVID. So now you can't find them. Automakers tried to hoard them. In time, they will go to a newer generation of chips, but that chip shortage has been pervasive. You see it showing up in everything from consumer goods to Russia's munitions and why they're buying things from North Korea right now. So record oil demand next year based on diminished economic expectations. I mentioned all these survey data we have, and we roll it up and put our monthly estimates out, freely available on our website, 2 months ahead of EIA. So some of the best data in the industry with no spin on them. It's just objective data. But is that a leading indicator of where global oil demand growth goes? That's one of the things that I've wanted to ask this quarter. So what you're seeing in this chart is a scatter plot of international oil consumption on the vertical axis versus US oil consumption from our data in the month prior. Pretty surprising, strong, almost one-to-one relationship of this period. Now I've taken 2020 out because of the pandemic, where you had different impacts and recoveries during 2020. But going back over this period to 2010 on a monthly basis, basically increasing at a diminishing rate, it's what you'd expect. And it says that when we look at US oil consumption, it can tell us something about where the world is going, both because the US is 1/5 of consumption, because the economies are intertwined, because we still have a lot of trade going on. And when we look at US consumption now, here since 2016, biofuel on the right, the high frequency indicators that we track by industry from air travel demand, manufacturing of different types, traffic volumes, freight shipping by truck, year on year, they're up strongly. Notice you see the downturn in the fuels. What happens when we come back out of the pandemic? The red area, manufacturing, petrochemicals, propane, propylene, medical plastics, films, packaging, everything the world needed through the downturn came from this. And we hit record amounts of over 6 million barrels per day at one point of just this. Quietly, more than 25 to 30%, depending upon the month, 25 to, and it got as high as 1/3 at one point, is stuff that has no emissions. It's just materials, but that's US petroleum demand for you. In EIA's estimates going out to the end of 2023 here, you see the strength, right? So even if there's a recession, even with diminished expectations, these are strong. This does not say record high prices are destroying demand. This does not say the sky is falling. These are the official estimates. Where the production comes from to meet the demand is a key issue. So the growth estimates out of OPEC in the United States and Russia are the ones we're going to focus on. So 4.4 million barrels per day of growth this year in terms of crude oil production. And the way to read this when you go to EIA's website is this is not what they necessarily think will happen. This is the assumption that's necessary to balance global markets in their modeling. And they have a modeling technique that forces a short-term equilibrium. And by the way, in reality, we have stock draws between the US and other releases, that low SPR, Strategic Petroleum Reserve that I mentioned, where we and other OECD economies are jointly releasing about 1.5 million barrels per day to make the global market balance. Without that, the market is short. Before Russia, Ukraine, coming into this year, EIA's estimate was that the world was short in the fourth quarter last year by over 2 million barrels per day. Those were stock drawdowns occurring before Russia-Ukraine. So nothing about taking or effectively taking Russian volumes off market to make that better. 2.3 million barrels per day of growth. Anybody follow OPEC in the recent meetings? Is that tracking? Very good. Not even close, right? So to start the year, they put a trickle of just a few 100,000 barrels per day on. With Biden's trip to Riyadh back in the spring, it was bait and switch where it's interesting. They were supposed to go, and then OPEC held its meeting in Austria. They announced that they were going to increase production, and the administration canceled the trip before going back in July. But in May, they canceled the trip and said, okay, mission accomplished, they're putting more on. And then within 2 to 3 days, egg on face, they realized that what OPEC had done was just take previously announced 3 months of increases and accelerated it to 2 months, but they didn't actually put more on market. And hence the trip in July comes, the administration goes and asks Saudi Arabia to put more on market, but it hasn't happened. And instead of working with US producers time and time again, the playbook for the administration has been to go to negotiate with Venezuela, with Iran, and with OPEC. And it's pretty clear in the wake of the July trip that there is no wedge between Russia and OPEC. That's also showing up again affirmatively in the wake of this G7 price cap proposal. US production growth of 1.4 is also not tracking. And we'll talk about the US production part next. So oil well productivity shown on the left, natural gas well productivity here at home in Appalachia on the right. Punchline out of EIA's estimates, this is how much oil or gas you get by running a rig for a month, down about average 20% year on year in the oil patch, 16% for natural gas fields here. This is not altogether unexpected. So if you drilled something during 2020, it had to be a really good well, your best prospect, your best rig, your best crew. So the productivity goes off the charts. And by the way, you were leveraging an inventory of previously drilled but uncompleted wells. And that in EIA's calculation adds to the numerator of the amount of production. That's a tailwind that has showed up this year. But again, if you don't have the same productivity, other things being equal, and you want to get production back up to its previous levels to match, you need more activity. You don't have more activity. Drilled but uncompleted wells, the so-called DUCs. I'm seeing it on my screen and I'm not seeing it on, for some reason it is. Okay, maybe it'll stick. Okay, well, hopefully people online are seeing it, and hopefully if you're not, if this isn't like looking into a strobe light, I apologize. But the map on the left shows the percentage of well completions as of July that came from DUCs, from wells that were previously drilled but not yet completed. And the thing that's stunning is that almost 1 in 3 well completions last year, US-wide, came from a previously drilled well. So very little drilling activity, majority DUCs. This year, as of July, only 2%, so almost none. And in some basins, and actually last month we looked at this for Appalachia, you were seeing in this region wells, this inventory of drilled but uncompleted wells building because companies couldn't find completion crews. So the availability of oil services, people to complete this, and here's the way it works. This is unusual, but for this year, private equity, private companies, not publicly listed ones, for the first time I can remember, are leading the majority of US oil production growth, the majority of it. Companies you've never heard of are the largest increases in US oil production this year. Companies, and I'll be honest and say, companies I've never heard of. Okay, and that should say something. And the reason this is happening is that the private companies had a higher risk tolerance. So at the beginning of the year, before Russia-Ukraine, they were the ones that looked at the prices and said, I'm willing to take a chance. And they went to service companies, they contracted for the rigs and crews. Then Russia-Ukraine happens, prices go up, you get as high as $130 a barrel. Now the major companies go and they go to the service company and say, okay, I'd like to add some rigs, please. And I shared a panel with the CEO of one of these service companies, and we were talking offline afterwards, and the punchline is this. They've got the margins back in the service side of the business. If you want the rig, They say, thank you, I'd like to work with you, but I'm sold out on high capacity rigs for the next 4 to 6 months. If you want one, I'll work with you, but here's what's going to happen. It's going to cost you 20 to 30% more than it did the last year. 2, you're going to put the capital up front. I'm not doing this on spec. So you're going to pay me however many million up front to refurbish this thing. It's been sitting in a field being harvested for parts for 2 to 3 years. So that's why we need to do this. And number 3, sorry, this isn't going to be a 6-month deal or a 1-year deal. I need a 1 to 3 year contract. That's the way this works right now. So the services companies have a lot of leverage that they haven't had really in a decade. And it changes the calculus of how this goes. But the numbers of ducks are down. If you don't have this, you don't have the productivity, you need more activity just to keep up. And I mean, there's almost no drilling, like fewer than 5%. Minuscule, nothing material in terms of growth. The pulse of growth is really unconventional at this point. And the leasing issue on federal lands is a separate thing to talk about in terms of access to resources. But the Gulf business, I mean, it does have good infrastructure. It can be competitive, but it takes investment and a longer time fuse. And people that have, if they want a quick return, they're looking to get production going within a month or 2 and get some cash flow out of it. The all-in view of inventories is this. I mean, I've told you this, that we've got these low inventories. This is the US view of crude and products, both strategic and commercial reserves together. That's the OECD-wide view. When you do it, and I've likened this to 3-card Monte. So what you've seen is the market in lowering oil prices recently has been reacting to the fact that, like, since the end of May until the end of August, commercial crude inventories actually went up. It went up by over 10 million barrels. But the strategic reserves were drawn down by more than 60 million barrels. Ouch. The all-in view of this means, as a world, and the OECD is really the only place that we have data on this, we're well below the 5-year range. If you want to know why your fuel prices have been elevated, look no further than crude oil. Another political diversion, and one that we've been fighting fires in Washington, D.C. about, is the call by the Biden administration for the FTC to investigate price gouging for gasoline, especially when it wasn't coming down in July as fast as they wanted, as prices went up and then started to fall. You can't micrometer this to the day or even the week, but when you look at a monthly basis, it's really obvious that when crude oil is your #1 input cost to making gasoline, it pretty much goes in lockstep between gasoline prices and crude oil prices. The white is the AAA average conventional gasoline price. The blue here is what refiners pay on a domestic and imported basis, as reported from the EIA, for their crude oil acquisition costs for all refiners on a weighted basis. So look, these prices, we know these have continued to come back down. If you want to know why the prices are still sitting around $90 a barrel, though, for oil, and gasoline is still over $4 a gallon, it's because of crude oil. The fact that the US is down, when we had the abundance of it and more production, the prices were lower. We had more of a cushion as consumers. Historically, that's been the case. Where this can go, if we energize domestic production and infrastructure, this relationship historically has stayed intact. I'm going to show you this first for gasoline and then for diesel, and you'll draw your own conclusions from it. But we're going to compare on the left what refineries produce of each fuel compared. And the red is the monthly this year and getting us through July. The blue area is a 5-year range. White line is last year. This says refineries produced well into the 5-year range. And in fact, toward the top of it, of the 5-year range consistently this year. The amount of demand, there's a little bit of price repression showing up in the July numbers with record high nominal prices, but also solidly in the 5-year range. Look at the exports doubling. We go from 500,000 barrels per day of exports in January, February to basically 1 million barrels per day by the summer. Hence, the inventories of the refined product, motor gasoline, recently below the 5-year average. Same story for distillates. So this is diesel fuel and heating oil. And the example I gave earlier is, let's talk about heating oil, which is a small, most of your distillates are diesel fuel, ultra low sulfur diesel. You can use either as heating oil. But this region, Central Atlantic and New England, use fuel oil, use heating oil for home heating during the winter. Normally, from the spring until right now, at the beginning of September, you build inventories. New England this time of year normally has 1 million barrels in inventory. 2 weeks ago, it had in the entire region only 2,000 barrels. Last week, the report was 30,000 barrels compared to 1 million on average. Again, you can use diesel fuel and substitute, but it costs more. And the inventories of this are still below the 5-year range. And on the East Coast specifically, just for this one product set, not gasoline, not jet fuel, just distillates, the inventories are 40 to 50% of what they normally are. If we're looking at heating oil in this region, Central Atlantic, it's like 20% of what it normally is right now. So this is why the Secretary of Energy has been writing letters to the member companies, to governors of different states saying, look at this, what are we going to do? And their knee-jerk policy or action is threatening basically to ban exports. Think about that. And by the way, in the fourth quarter last year, Secretary Granholm threatened to ban or limit exports of natural gas and of crude oil before Russia-Ukraine. Now the tone has changed. A lot of international commitments to send this and support Europe. But yet, even in this environment, the administration is working with the states to possibly ban distillate exports. So look, these are politics as they play into energy. It is the way it is. It's the data and the way we see it, but it's all born of just thinking economically in terms of scarcity. Refiners are trying. The demand is there with the economy. The exports have doubled because there's a global need for it. In the past, we've been able to say successfully as an industry and document why, as exports grow, you motivate more domestic production, and that's a good thing. This year, because of these historically large changes, doubling of this, it's very hard in the short run to adjust to that. Natural gas, very quickly, and then open to questions. I mentioned the record prices for natural gas internationally, never higher. You see this on the left. The little white area on the left at the bottom, that's Henry Hub spot prices. And we've been sitting in recent days between $8 and over $9 per million BTU Henry Hub spot. That's more than double what it was 1 year ago. We are concerned when that happens. Let's understand why it's happening. And when you think about coal production in this region, Pennsylvania, West Virginia, normally the thing that helps back natural gas out of the power sector is coal production. It used to be, if gas got over about $4 per million BTU, it lost to coal. Coal would come in, and that would help normalize and be a price signal, if you will, but it was the way the market worked for natural gas that was a limiter on it. That's broken now. Eastern coal prices are tracking global hydrocarbon prices. There's a huge pull for coal exports in addition. And by the way, you think we have workforce challenges, try to get coal miners in this region. It's not like mining productivity is picking up either. So that's another thing to watch is what's happening on the coal side vis-a-vis its interaction with natural gas. The one thing that you can say is maybe a silver lining for US consumers is that the US is only capable of exporting so much natural gas. Via pipeline, both to Canada and Mexico, the Mexico volumes have grown over time. And then the amount of LNG has been hitting record levels, but we've also had some setbacks this year with a fire at Freeport, with limitations on how much can go out without expanding terminals more to come on this. The EIA's expectations, their expectations are that we'll get out to 15 billion cubic feet per day of net exports by next year. So if this continues to grow, we'll see if they continue to permit and expand LNG, you can't do it without supporting domestic production and not have boiling frog syndrome for US consumers along the way. Now, one of the emerging issues for natural gas is food security globally. This is a hot issue. I've shared panels with the chief economist at the American Farm Bureau on a few things. The left-hand side is basically longstanding projections of as world population grows, you need more fertilizer. It's endemic. In the IEA's view, the single fastest growing source of natural gas non-energy use has been fertilizers and is projected to continue to 2025 that way. Now, you use natural gas to produce nitrogen-based fertilizers. It's the key. And the Farm Bureau tells me that if I have organic fertilizers instead of natural gas-based ones, that my crop yield drops by 80 to 90%. Now, look at the United Nations tracking of they compare on a crop year that goes from June to June for a crop year, the normal imports of nitrogen-based fertilizers with what countries have actually taken. And through the end of June, the whole world lights up in red. So this tells us there's a shortfall in terms of how much nitrogen-based fertilizer is going into food supply chains around the world. In the US, in Europe, relatively wealthy economies, we could afford to pay more and substitute it, and we'll find a way. Many emerging economies around the world, this is potential hunger. So this is something that, again, has to be watched. It's not factored into the high-level global economic estimates that I'm showing you, but it's one of the scenarios that needs to be genuinely watched going into this next year. I mentioned the growth to 15 billion cubic feet per day of natural gas exports. You see this per EIA on the left. The interesting thing is that they're showing gas getting backed out of the power sector. Well, that only happens because they're assuming coal production increases. So that's another thing we need to watch. The potential or the upside potential for LNG exports is shown. We've seen more projects pull the trigger with affirmative final investment decisions. So the blue area, ones that are definite moving forward, have gone up to 22, 23 billion cubic feet per day in ultimate capacity. But we could double that. We could more than double that if we had a concerted effort as a nation to support that. Last couple of slides here. Part of the reason also that we have elevated natural gas prices right now and home heating bills this winter are expected to be high, our inventories, our injection into storage. Natural gas is always a seasonal market, right? So until you get to the winter months, you spend all of the spring, summer building up gas and storage so you can draw it down during the winter. Our injections right at the bottom of the 5-year range, historically low. So remember I showed you strong production, right? Thanks to natural gas, top of 5-year range in terms of production. But we're also exporting a lot. And combined with this, it means that prices are elevated partly because of relative scarcity here. EIA's view of prices is shown. You see the actual change in prices up to 2021, even through the downturn. You see the normal seasonality there with natural gas, right? But this last year, look how the curves get bent. And in their projections going out through next winter, they've got $9 gas projected through next winter, then dropping back to about $6, which is still twice what it was pre-COVID. So in EIA's view, consistent with futures markets, the curves get bent here. Petrochemicals, this is where we're going to end. The left-hand chart is something that I show as sort of a bread and butter value chain chart. So if you think about making petrochemicals, let's say the building blocks of plastic, polyethylene, polypropylene, produced from ethylene and propylene, produced in turn from ethane and propane. Now, when you produce gas, natural gas here in Pennsylvania, you fractionate that gas, you chill it, and you drop out natural gas liquids, including ethane, propane, butane, field natural gasoline. That's what you get out of it. And about half of that NGL barrel, so to speak, will be ethane. Hence building Shell's ethane cracker here in this area, right? Or close to Pittsburgh. But you have a choice, an economic one, whether to take the ethane out of the natural gas stream. To a point when you produce natural gas, and if it's not just dry gas, parts of Pennsylvania, Southwest Pennsylvania, Ohio have wetter gas with NGLs in it. The red line shows if the BTU equivalent, ethane BTU equivalent price if you're keeping natural gas in the stream. So ethane's hotter than methane. It raises the BTU content. It has some value. You can show it. If there's a margin that's profitable by taking it out, you'll do it. And that ends up being your main driver for this. Propane is more expensive than ethane. It has an even higher BTU content shown in orange here. And the message last quarter was that these prices had gotten to some historic levels. I've worked on an ethane cracker and derivatives complex, and I'll tell you that the ethane prices that we've been looking at, we're talking 30 and 40 cents per gallon, or twice what a petchem plant might have planned on with the energy revolution over the last several years. You might have planned around 20 to 30 cents per gallon. Well, companies like Dow and others have historically, every time natural gas and ethane prices go up, they would go to Washington and other places and say, you need to do something about these natural gas exports. You need to curb this. This is part of why Secretary Granholm in the fourth quarter last year was wanting to cap or limit natural gas exports. Well, why were they silent? Why have they been silent recently? Well, through the first half of this year, look where you see Brent crude oil having gone up through July, right? Well, your global price setter for all these plastics is usually a petchem firm either in the Middle East or Asia that's using a liquid, using naphtha to produce that same plastic. In the US, we've had a feedstock advantage by using ethane or propane. Historically, you would build crackers to have flex fuel, the ability to switch between ethane and propane. In recent years, because of the strength of the shale revolution, almost all of them have been pure ethane crackers. So as of June, printing money, record high refining and petrochemical margins. You see this here, come down, going back to last year. Even though the feedstock was elevated in cost, the margin was still quite positive. That has changed recently. And the first time in 5 years, if you're using ethane to make ethylene, you have a negative margin. This is not a good sign for the next investment in ethane cracker in Pennsylvania or Ohio, right? If I've got a record high dollar, it's very expensive to try to produce this. So the petrochemical firm would rather have the feedstock, put the next petchem thing that's needed, plant that's needed in the Middle East or Asia, close to the demand center. If we're going to be competitive as Pennsylvania, as a region, as a nation, this is something that just cyclically can't change like this. So these are the things that we look at as leading indicators of how do you keep the shale revolution going? What's it mean? What incentivizes investment? And it starts fundamentally with having support for domestic production and some consistency with the market. Right now, again, the international pull for things has been historic in the wake of Russia-Ukraine, but many of these problems were pre-existing well before them. So I'm going to wrap there. Welcome questions, and feel free to ask me about pretty much anything energy related. It doesn't have to just be this, but this is how, when I educate audiences and talk about whether it's with member companies, policymakers, this is the pack you're reading it exactly the same as anybody else sees it. Absolutely.
For a couple of questions, and I'll be sure to take some from here and some from Zoom. But Dean, could you remember just to repeat the question?
Sure.
After you hear it for those who are on Zoom.
Gas reserve and production really able to build that. My question is, why are we still a net exporter? Are we not using that to satisfy our demands in the US? And so my second, I guess this is a question that most of us students have. How is this situation going to affect the job opportunities for us, job seekers?
Thank you. So to repeat the questions, and I'll paraphrase. One is, given the circumstances we just talked about, why are we still an exporter as the United States? And the second is, what does all this mean for job opportunities? Once you commit to globalization, to a business model where you invest billions of dollars supporting exports, supporting allies, telling Europe, we're behind you. There's a joke, by the way, I'm behind you. I'm way behind you, and backing up, right? And that's kind of what the US has been doing with Europe here, because you can't say, I'm going to ban these exports and say, I'm committing to be behind you, Europe, as you are being pushed with this G7 proposal in particular, the price caps with Russia. I mean, we are encouraging them to play chicken with Russia, forcing Russia's hand and bluff, saying Russia has signaled they'll have a strategic response and cut off supplies. Will they? Won't they? I mean, they've already done it with natural gas. Will they with liquids is the next question. The liquids are more fungible, and it's easier for them to cut off Europe and maybe try to redirect some of those volumes. But why we are a net exporter comes down to those, both the business commitments we've made and the political relationships that we strive to maintain. From an Asia-Pacific standpoint, there are two things I guess are worth knowing about the LNG business. One is that historically the prices were always related to oil contractually because of oil versus gas switching in power across Asia. That's come back strongly this year. It's the first year in a long time where we've seen that. The second is that security of supply is one of the prime business considerations in whether somebody will sign a long-term contract for LNG. And the US has been seen as a relatively more stable, consistent partner. In Texas last year, during the winter storms, Governor Abbott invoked diversion rights for a couple of weeks, keeping natural gas from being exported. I mean, there are precedents where for a short period, people do this and they say, no, I gotta have it. And that could happen here too. And for a question that Seth was asking earlier, very similar about, well, what if we just banned exports for a short period? That could happen too. I'm not saying it's a good thing. I think it has repercussions. It sets a bad precedent. Would the sky fall? Maybe not. But your reaction is the same one that I get from many colleagues in Washington, D.C. and from policymakers that think that way of, well, why don't I just cut it off and make sure I've got it at home? And that could happen. It's something we have to watch, but it's really costly from a longer term perspective in terms of the confidence in continuing to grow it. In terms of what this means, honestly, for opportunities in the industry, I mean, at the production level, we've got service companies that are going to retail malls across the nation, trying to scrape to get people to join companies and work in the oil field who've never worked in an oil field before. Truck drivers nationwide, short supply. For educated positions in the industry, the mantra that we had in 2015 was, it was called the crew change. Half the industry eligible to retire within 10 years. COVID accelerated a lot of that. So the opportunities are definitely there. And for, I'll tell you, having visited other universities, and part of the reason I'm back is that this is a good program. You are training people to think about, from the minerals on through the markets, how to think holistically about these things, the technology of it, the markets of it, the economics of it. There aren't a lot of places that do that. So when, we need policy support for this industry to continue, but you're the workforce that matters. And you need to have confidence that the sheer enormity of the global energy needs and US energy needs says this is going to be around for a long time to come. I personally think, I mean, I'm still invested. I'm not going anywhere for a long time. I think it's a good career opportunity. So I see that continuing pressure. It's not the normal cyclicality here. And what looks like a downturn in oil price, and as API for a trade association, we can't for antitrust reasons predict prices. That's why I leverage a lot of external forecasts and take them apart. But the fact is, the world is short of oil and natural gas today. The fundamentals show that, and it's only by virtue of strategic petroleum reserve releases that we've continued to bridge that gap. You can't do that indefinitely. Once you get past, and the US announcement, which is by far the gist of the global release, once you get past October, that's the announced end of it. We'll see how far that goes. But at that time, unless the economy falls out of bed in a way that the consensus really doesn't foresee, and again, we talked about food, we talked about trade balances for emerging markets, there are scenarios. These are serious. But the base case expectation on the heels of $20 trillion of stimulus says there's opportunity here. And a need, a dire one. Thank you.
Do we have any questions on Zoom? Okay.
I will, let me just invite you, feel free to reach out on LinkedIn at api.org. There's the Chief Economist section. And this presentation, which this version of it that you're seeing, by the way, you're seeing early, it's going to come out on the 21st. But our monthly statistical report, the data 2 months ahead of EIA that I mentioned, that's out. We have a weekly report that takes the weekly data apart. Whatever you're interested in the way of industry data and getting it down to a digestible format, please feel free to reach out with questions and take advantage of that, or data visualizations, lots of cool toys. Please.
Do you think that 20% of one reason that people have?
So the question in the room is, what about climate policy? Or it's more than just climate, it's ESG as total, but environmental policy and energy policy have been almost inextricable in recent years. And as API, we're actively supporting a price on carbon. We have an environmental partnership with almost 100 companies, members and non-members, voluntarily taking on best practices to reduce emissions. We recognize that the world's moving forward, and if we want to have a voice in it, we have to continue to engage in that and do better. there are different levels of emissions, scope 1, 2, and 3, getting through the actual use of the product that are hard, how you measure these, how you control for them, whether you have carbon offsets in markets. There are lots of considerations. Promoting CCUS, carbon capture, use, and storage, another potential area. There's not a single, by the way, model post-2050, if you're looking at long-term energy and climate modeling from the Stanford Energy Modeling Forum and others. By the time you get past 2050 and you want to go to 2100, keep in mind that usually a decade is a tick in one of these models. All of these models invoke CCUS. If you don't have carbon capture, use, and storage coming into play, it's really hard to get to any of the climate consistent paths in terms of temperatures. So technological change, a lot of investment. It's not just clean energy investment, though. It's the only thing. And I'll tell you, I was in Tokyo last month and presented at the International Association for Energy Economics conference. And many people privately acknowledge where there are issues trying to get more and more renewables, just clean energy into the mix for grid reliability, resiliency, cost effectiveness, lack of cost effective energy storage, lack, frankly, of the same challenges that we have as moving pipelines through this region, trying to get to New England, try to move high voltage lines, electricity lines. Petroleum Marker told me recently that the most money they make is putting diesel generators in to supply Tesla superchargers in California because they can't get the high voltage lines built. So again, we have to back up and realize that this transition is inevitable to a certain extent, that the technology is evolving, there's support for it, there's a desire and a need for it, but it has to come in context with realism about what we can do and how fast. And hence that second slide I showed you after the summary of really looking at just the sheer magnitude of how much. So I think as an industry, we're aligned in recognizing that we need to continue to do better and be part of the solution, not part of the problem. And we're trying, we're getting there. Please.
Go ahead. We'll make this the last one.
Sure. Are you differentiating that? Well, whether I use a tariff or I effectively cap the price and say I will pay no more than X. The way I understand the Russian price cap proposal came about, it wasn't necessarily side by side with tariffs that I heard about. The way it was recounted to me was that with some MIT economists, she had put her minds together and they wanted the perfect academic solution to a real world problem. And on paper, it seems quite elegant, actually. And I think there are a lot of parties that would like to apply more pressure to Russia to comply one way or another, whether it's via tariffs or a price cap here. The difficulty has been, we mentioned compliance, that's one. I mentioned crude quality at the outset. So thinking through the fact that Russia does export some medium and heavy crude that the world needs that you can't easily replace. So depending upon the refiner, the efficiencies of matching crude quality with what products are actually needed to be produced and the refining capacity to make that crude processable. So cracking and coking as opposed to just distilling oil. That's another consideration. And the third was whether to be a strategic response from Russia or OPEC in putting this in place, and whether I'd have to think through the implications of a tariff versus the cap. But the one thing that has become clear is that two of the three things that I mentioned are prominent in the sense that the strategic response is already in the headlines, and the fact that there's a lack of compliance is showing up in the existing data already. So the ability to game the system is rampant. I think with the exception of unfinished oils to the tune of about 500,000 barrels per day coming to the US. The US imported in 2021 no finished products from Russia, but we did import a couple 100,000 barrels per day of crude oil and 474,000 barrels per day of unfinished oils that were essentially heavy oil used to produce distillates, especially on the East Coast. This is part of why we have the heating oil and distillate shortage that we do. I fielded a lot of calls from House Ways and Means and other committees before this got enacted. And the way it played out was they wanted something that they wanted to know, is this largely going to be symbolic or is it going to be meaningful? And the more you turn the dial from being symbolic is I look like I'm doing something, but I haven't effectively removed the volumes, to being meaningful means I suddenly, I don't just ban the direct importation of Russian finished or intermediate products or crude, but if it went through the CPC pipeline through Kazakhstan, I wouldn't take it. If it is effectively Russian-owned crude production in Venezuela, which has been a trade, why the heck am I negotiating with Venezuela to take their barrels when they're Russian-owned? Some of them, China-owned and Russian-owned. That's been the tit for tat or the quid pro quo for Venezuela in exchange for currency from both Russia and China. These are the issues where effectively the system is gamed. So I don't know if we had gone, which mechanism we use, I don't think makes a meaningful difference there. Yeah, happy to chat. Thank you.
Well, I want to thank everybody for coming, and I especially want to thank Dean for giving us a lot of really interesting information. So thank you very much.
Gladly.